All right, let's jump right into this explainer. Today, we're tearing down how Enova International absolutely engineered a massive, record-breaking quarter. You know, when you peel back the layers of high-yield online lending, it's rarely a simple story. But what we're looking at here is a genuinely fascinating look at a company operating a staggering $5.3 billion loan portfolio. We're going to examine exactly how they built this machine, step by step.
To really figure out what makes this business tick, we're going to break things down piece by piece. We'll hit the record Q1 2026 results, dive into the core business engine, look at margins and profitability, tackle how they manage credit risk, and finally, wrap up with capital returns and their outlook. Let's get into it.
Kicking things off with Section 1, Record Q1 2026 Results, Scaling Up the Balance Sheet. You really can't appreciate where they're going without looking at where they just came from. Think back to 2024. They laid down this massive historical baseline. We're talking $2.7 billion in total revenue and $4.0 billion in ending receivables. They essentially proved they could grow profitably while keeping a rock-solid balance sheet. And honestly, that foundational strength is exactly what set the stage for the explosive double-digit growth we're seeing right now in 2026. Just look at this year-over-year leap. It's actually wild. Comparing Q1 2026 to Q1 2025, total revenue shot up to $875.1 million. That is a 17% jump. Net income grew 25% to $91.1 million. But the real kicker for investors, diluted earnings per share skyrocketed by 29%, going from $2.69 up to $3.46. That is textbook operating leverage right there. As their revenue climbs, their profits are climbing even faster. Which brings us to the absolute headline metric of the quarter. Enova hit a record $5.3 billion in combined loans and finance receivables by March 2026. To put that into perspective, that balance was fueled by nearly $2.3 billion in originations just in the first quarter alone. That's a 33% spike in originations from the previous year, just an immense amount of capital flowing through their systems in 90 days.
So, how exactly are they consistently generating this kind of output? Let's pop the hood in Section 2, the core business engine, products and portfolio mix.
Enova isn't just one single brand. They run a highly flexible, online-only model serving underbanked folks through a bunch of specific, targeted names. In the US, you've got CashNet USA and NetCredit for consumers, plus Simplex down in Brazil. For the small business side, they use OnDeck and Headway Capital. Over their 20-year history, they've processed over 65 million customer transactions. All that data, it feeds directly into their world-class analytics and machine learning algorithms. Here is the crucial takeaway, though. While everyday consumers might recognize those retail brands more, small business lending is the actual engine driving this train. As of March 2026, small business loans make up a dominating 70% of Enova's entire portfolio, leaving consumer loans at just 30%. You absolutely have to understand this mix because it dictates both their revenue yield and their risk profile.
Now, you might be asking yourself, why is there so much heavy volume from small businesses right now? Well, management pointed out that it's being driven by surprisingly strong economic sentiment. Based on their recent cash flow survey, a whopping 94% of small businesses expect to grow over the next 12 months. That ties an all-time high. These businesses need quick, reliable access to capital for payroll, inventory, you name it. And Enova's automated platform is just perfectly set up to catch that wave of urgent demand.
Of course, pumping out billions in loans is really just half the battle. Let's move on to Section 3, Margins and Profitability, Operating Efficiency, to see how they convert that crazy top-line demand into actual bottom-line profit.
This brings us to a really standout profitability number. In Q1 2026, Enova generated $227.4 million in adjusted EBITDA. That is a massive 20% jump from the $189.9 million they saw the year prior. So they aren't just scaling up, they're doing it while keeping strict cost and pricing discipline totally in check.
Just to make sure we're all speaking the same language here, adjusted EBITDA is basically just a way to measure pure operational profitability. We strip out the non-cash items, the interest, the taxes, and any weird one-off expenses. What you're left with is a super clear picture of the cash this lending engine is actually throwing off. And as we just saw, it's churning out nearly $250 million every single quarter. You can really visualize this efficiency by looking at their expanding net revenue margin. This metric grew from 56.8% in Q1 of last year up to a highly stable 60.1% by the end of Q1 2026.
What does that mean for us? It means for every dollar of cleaned up sales, Enova is pocketing over 60 cents in net revenue. It proves their algorithms are finding highly profitable loans, even as they dramatically increase their marketing spend.
But hey, let's be real for a second. High-yield lending carries some serious exposure. Which takes us to Section 4, Managing Credit Risk, the safety features. Let's break down the risk versus the mitigant. Because 70% of Enova's portfolio is tied up in small businesses, they are heavily exposed to uneven cash flows and big swings in economic demand. If the economy takes a hit, small businesses feel it first, for sure. But here's the clever part. Enova intentionally uses that 60% net revenue margin as a giant shock absorber. By pricing their products to keep that margin super wide, they build in this massive buffer. It allows them to absorb higher charge-offs and credit bumps without completely tanking their bottom-line profits. And their filings show that their proprietary machine learning models are actually working incredibly well. Think about this. Despite growing their loan originations by an insane 33%, their credit metrics actually got better year over year. The net charge-off ratio, basically the percentage of loans they have to write off as a loss, dropped to 7.6%. At the same time, their 30-day delinquencies ticked down to 7.4%. Growing your loan book by double digits while simultaneously dropping default rates, that is literally the holy grail for a fintech lender.
All right, with margins looking healthy and credit under tight control, let's peer into the future with Section 5 Capital Returns and Outlook, the road ahead.
Enova's CFO, Scott Cornelis, really hit the nail on the head here. He emphasized their confidence in driving consistent results, heavily backed by their balanced growth and strict unit economics discipline. And they've got the firepower to back up that talk. Enova reported $1.1 billion in liquidity, over $474 million in operating cash flow, and a completely resilient balance sheet. They're in a prime position to start returning major value back to their shareholders.
When you look at the roadmap laid out in their filings, Enova is not being shy about deploying that capital. They actually just killed their old $300 million buyback program, only to immediately replace it with a brand new, expanded $400 million share repurchase authorization running through mid-2027. They are quite literally buying up their own success because management clearly believes the stock holds massive long-term value.
On top of all that, they're strategically stepping way beyond just being an online lender with the pending acquisition of Grasshopper Bank. Pending regulatory approvals, management expects this to close in the second half of 2026. Once that integration is done, it's projected to significantly boost their earnings per share, lower their cost of capital, and just massively expand their overall capabilities.
So I'll leave you with this to chew on. Enova has proven they can scale originations to absolute record highs while keeping defaults remarkably low. Armed with these powerful machine learning analytics, a massive 60% revenue margin acting as a shock absorber, and a multi-billion-dollar war chest, can this fintech engine continue to perfectly thread the needle, balancing high-yield rewards against whatever economic speed bumps lie ahead? It is a genuinely fascinating company to watch, and the numbers absolutely demand your attention. Thanks for hanging out with me on this explainer, and as always, keep questioning the data.